In this video, I will be introducing allocation and depreciation of difference between implied and book values. Actually, we already learned the allocation part. Remember when I pulled part of Chapter 5 forward? That was the allocation part. We allocated the difference between implied and book first to any fair value adjustments that needed to be made, and second to goodwill or gain on bargain purchase. However, as time passes, we may need to make adjustments to these allocations as assets are used up, sold, or impaired. That's the depreciation part that we will be talking about in this video. In your accounting career so far, you've had a pretty strict definition of depreciation. You're going to need to loosen that up a little bit in this chapter. In our eliminating entries thus far, our last step had us allocating the difference between implied and book to fair value adjustments on the balance sheet. Now we must consider the fact that the net assets we wrote up to fair value, those owned by the subsidiary on the date of acquisition, will not remain on the balance sheet forever. For example, the inventory owned by the subsidiary on the acquisition date will be sold and removed from the balance sheet. When that happens, the corresponding fair value adjustment must also be removed from the balance sheet. As items are removed from the balance sheet, they typically impact the income statement in some way. In our inventory example, inventory that is sold is removed from the balance sheet and placed on the income statement as cost of goods sold. So when the inventory that existed on the date of acquisition moves off the balance sheet and into cost of goods sold, so should any fair value adjustments related to that inventory. In the year the inventory is sold, we will include an additional eliminating entry that removes the fair value adjustment from the inventory account and places it on the income statement in cost of goods sold. So for a fair value adjustment that increases inventory by $20,000, we would debit inventory for $20,000 in our allocation entry. We would then add another eliminating entry that credits inventory to remove that $20,000 fair value adjustment and moves it to cost of goods sold with a debit. This is another place where I add a few extra steps from what your book does. Your book will combine both of these entries with the entry to eliminate subsidiary equity. In a relatively simple example like this, that's fine. However, the more fair value adjustments that an acquisition has, the harder this is to keep track of. My way definitely can seem silly at times, but you're much less likely to get yourself turned around on a complicated problem. Now let's consider the next year. Remember that we will start all over with our eliminating entries. Nothing we did last year will carry over. We will again allocate our difference between implied and book to inventory. But we know that's not right because the consolidated entity no longer owns that inventory. We sold it last year. However, we can't move it into cost of goods sold again because that would mean we sold it this year. What we do when the fair value adjustment passed through a prior year income will depend on whether the parent company is using the cost or equity method to account for their investment. We will start by crediting inventory to undo our fair value adjustment for the allocation entry. We will then split this amount based on ownership percentage, with the parent's portion going to 1/1 retained earnings of the parent and the remainder going to the non-controlling interest. We will use 1/1 retained earnings of the parent here for the same reason that we use it when we do our entry to establish reciprocity. If we had been using the equity method, this difference would have been reflected in the parent's investment income and thus already in retained earnings. So what if the parent had been using the equity method? Then the adjustment is already reflected in retained earnings, which is good. However, the recording of equity income on the parent's general ledger will have left a balance in the investment in S account that will need to be eliminated. Therefore, if the parent company uses the equity method, we will swap out the parent's portion of the reclassification entry to debit investment in S rather than 1/1 retained earnings of the parent. This concludes our introduction to allocation and depreciation. Don't forget to email your questions for our discussion.